All right, welcome and thank you for joining us today. I'm Tatia, CEO and founder of Upnotch. Upnotch is a free mentorship platform for executives, entrepreneurs, and professionals. We bring together industry leaders and like-minded individuals to share knowledge like today through one-on-one mentorship or mentor-to-mentor talks like the one we're going to do today. For updates and info on future talks, you can sign up on upnotch.io, and we look forward from hearing from you. So today, we're really excited to hear from our very accomplished panelists, sharing their views on what's happening with investment trends during this pandemic. Our moderator is Chris Young, entrepreneur at heart and co-founding partner of Revel Partners. Revel is an early stage venture capital focused on financing B2B software companies. Chris, thank you so much for being here today and for leading our conversation.
Fantastic. Well, thank you so much, Tatia. Thrilled to be doing this, and I'm thrilled to be joined by these wonderful panelists and to chat with the audience, I guess virtually. We've had 70 questions submitted ahead of time, so we're going to try and we've incorporated a lot of those questions into the content. So try to get to all of those. Definitely everybody in the audience, feel free to use the Q&A function to throw in some questions that you have in real time. My colleague Jake Kupperman, who helped spearhead the survey of the venture community during COVID that we'll be kind of talking about today, some of those data points. Jake's going to be manning the slides, and we'll be also manning the Q&A. But first, why don't I kick things off by introducing our illustrious panel. First off, we are lucky to have Kim Perell joining us. Kim is based in San Diego. She's a serial entrepreneur with multiple large exits under her belt. She's also a New York Times best-selling author of The Execution Factor: How to Kick Ass and Take Names and Execute. Most recently, Kim was the CEO of MarTech behemoth Amobi, which is the US subsidiary of Singapore Telecom. Kim is an active investor in over 80 different companies. She has her own fund now, and she's supporting startups and mentoring entrepreneurs. Also, a couple of interesting things to note about Kim. She also hosted Good Morning America's Side Hustle Showdown, which was a week-long competition last fall for aspiring entrepreneurs to win capital for their side hustles. And in addition, Kim regularly appears as a judge on Entrepreneur Magazine's Elevator Pitch video web series. So you should definitely, after today's call, go check out Kim on a couple of those platforms. It's really fun. In addition, we're also fortunate to have Randall Lucas joining us. Randall is based in Seattle. He is a partner at Voyager Capital, $100 million fund, where he's focused on early stage B2B investments in the Pacific Northwest, primarily in the areas of analytics software and financial technology. Prior to Voyager, Randall was a founder or operating executive at a number of startups, including co-founding Simple Verity, and he was a principal and head of product at Lighter Capital. We're also joined by Thomas Falk, who splits his time between Berlin, Dusseldorf, and New York City. Thomas started his first business at the age of about 19, sold it to Google in 2006. Thomas and I co-founded Revel Partners along with our other two partners, Joe Prendy and John Vincent. Among the four of us, we've started and sold 11 businesses before getting together to form Revel in 2011. So Revel, we've got 2 funds and 40 different portfolio companies across the 2 funds. And we're, as Tatia mentioned, exclusively focused on early stage B2B software companies. So very much aligned with Voyager. Kim does a lot of B2B investments, but also B2C as well. So with that, let me jump in and we'll get started. And I'll start asking lots of questions of our panelists. And I've included a lot of your questions, audience questions, into the questions I'll be asking. And again, thank you for submitting so many great questions. So we've kind of weaved those into the content today. And as I mentioned, if you've got any questions that come up, feel free to use the Q&A function to submit your question. And by the way, as I look at myself on the video here, I promise I do have ears here. They seem to be cut off with the virtual background. Okay, with that, okay, New York City, in April, we did a temperature check, if you will, of beginning to analyze the impact of COVID-19 on early stage venture in New York. And we asked a bunch of different questions around willingness to invest, investment cadence, strategy, virtual meetings versus in-person meetings, valuations, and we surveyed 33 different early stage venture capitalists within the New York City ecosystem. So we're going to share about 5 or 6 different slides covering off on some major points, and we'll have the panelists kind of interact and give us their thoughts around that. So the first question that we asked was around willingness to invest, and how is your firm reacting to the current investment environment? And generally what we saw, and as you can see here, over 60% of all investors are investing less or holding off until there's more market stability. So I guess, you know, with that, I guess the first question, and perhaps for you, Randall, is, you know, I guess from a macro perspective, how much has COVID caused you to alter your underlying investment theses? What's been the impact on your investment strategies? And I guess from a micro perspective, are you still investing?
Yeah, thanks for the question, Chris. So I've had in my unscientific sample size, I've had a slightly different perspective on it. Most people who I've talked to have tried to stress, oh, we are still in business, we're still investing. And certainly our public facing statements at Voyager have been the same. We like to say we're still in market, we're still investing. How COVID has affected that tactically and in the short term is that, frankly, between sort of April 1st and early June, there was a big drop off in deal flow. So we were seeing many fewer deals get done. We had the benefit of going into the COVID situation with a strong pipeline and stuff that we were working on. So we actually ended up closing a deal in April and a deal in May. But these were companies that we had known for several months at that point and had kind of worked through the pipeline of getting to know them, term sheet, negotiation, and diligence. And so we did close a couple of deals in the early part of COVID, which, given that we're a small fund, given that we only do approximately 5 deals per year, closing a couple deals in the beginning of COVID felt like everything was normal. But then I'll say that there was a little bit of an eerie silence, at least here in the Pacific Northwest, where it was much reduced. I'd say deal flow was down by about half. The good news, in my view, is that starting probably the second week of June, that seemed to turn around quite a bit, and deal flow picked up. And I'd say that we are gladly kind of getting back on course to a pace of working on investments in our pipeline. Strategically, so that's sort of tactically what's been happening. Strategically, our view, and I think the public view of a lot of folks, and I hopefully the private view as well, is that venture capital should not be a week by week, month by month, even quarter by quarter, get in the market, get out the market. You know, you raise a fund and you have a new investment period, and you should kind of put it to work. That's what your partners are paying you for. And if in fact you are a traditionally structured fund, and we are. So we view the world through the lens of, we have a fund that was closed last year. Our fund did a final close in September of 2019. And so our investors expect that we will put that to work over the course of 19, 20, 21, 22, whether that is a pandemic time, whether that is an up market, down market. So we're trying to stay the course, and happily in the last, I'd say 6 weeks, the Pacific Northwest has experienced a good uptick in deal volume, and folks are coming back out with great ideas, and in some cases with counter-cyclical or counter-COVID or COVID tailwind strategies, which is great to see.
Great, great. Kim, what are your thoughts in terms of what you've been seeing in San Diego, and in terms of this data set was beginning of April. What are you seeing in the market in terms of angel investors and venture funds willingness to invest?
I think at first there was a lot of caution, right? And I think similar to Randall, it just, the uncertainty put a lot, maybe a pause. I think now I've actually seen quite a few good deals come through. I think people are more open because this is the new normal. So how are we going to adapt to it? And I think there's been a lot of great ideas that will come out of the crisis. So I'm actually very positive on what I'm seeing. I think, listen, great companies are made in bad times, and there's going to be a lot of companies that are going to come out of this, in a good place. So I'm pretty bullish. I think obviously there was a pause, but I think that we're now seeing a lot more action.
Great. Great. Well, moving on to the next slide, in terms of valuations, we asked, how do you believe startup valuations will be affected in the coming year? And this is kind of the million-dollar question that everybody's, trying to get their heads around. In this survey, beginning of April, 60% of investors believe that valuations would decrease by at least 20%. So I guess, Thomas, what level of valuation drop are you currently seeing in the market? What do you expect to see going forward? Be curious to get your thoughts.
Yeah, I think 20% are roughly in line of the deals which we have seen recently. So given this holdback in March, where basically the world stopped and nobody wanted to fund any business for any valuation, so the market came back now, and what we're seeing is so that good companies always gets funded. Now, we have done 5 deals this year so far, and I think we are going to continue. But I must admit, yeah, so when we are entering into the negotiations also with the founders, yeah, so we discount right now the current environment, and I think 20% is probably right now a good number. Going forward, it depends on the market. Right now, you have this decoupling from Main Street and Wall Street, yeah, so where a lot of money is in the stock market, but we see a drawback in the economy. And until we have figured out how will that impact our portfolio companies or our future investments, we will be cautious.
Great, great. And then, in terms of, I guess a question for everybody, in terms of Europe versus West Coast versus East Coast, what's going on in each market? Are things materially different in each, or is it pretty much the same, from east to west and then across the pond over to Europe? I mean, Thomas, are you seeing valuations pretty much consistent across the board with Europe and North America, or are you seeing some differences?
Well, there was always a valuation gap of probably 20–30% between US companies and European investments. And so right now it's pretty much stable here in Europe. Yeah, so probably also the crisis is, let's say, was not so horrible in Germany, especially, than it has been in other countries. So therefore, the market is quite strong on the valuation side. Other markets, so like Italy or Spain, yeah, so where you see way further and lower valuations if deals are even getting done. Yeah.
And Kim and Randall, have you noticed anything geographically speaking from east to west, or it's pretty similar across the country?
I mean, I've seen, honestly, I think it's been similar. I think there's just the caution, right? To Thomas's point, it's just making sure like the investments, are solid and looking at like, where are you going to place those bets?
Yeah.
And
Good.
with a very narrow sort of drinking straw view of the world that I have anecdata on that, and that is that if a company is raising based upon observable metrics, so if you're raising because you've got good ARR and good growth and good retention numbers and LTV CAC and all these numbers that are relatively familiar to an investor, relatively easy to assess, and relatively easy to diligence even remotely, you are now possibly even receiving a new crop of bidders, right? Because Valley firms are now looking at your deal in Vancouver, British Columbia, for example. And that may in fact create more bidders. And so valuations have not been pressured, in my view, for highly performant, observable metrics driven fundraises. So if you're doing great and it's obvious from the metrics, you're in the catbird seat. Where it has been hit more is in deals where it's betting on a founding team, where it's pre-product market fit, where traditionally it's been areas where it's been personal connection and kind of assessing and getting to know entrepreneurs and kind of coaching and working them through that early stage of figuring out what the heck they're going to do. Those deals tend to, they have had a little bit more of the valuation pressure, in my view, and in my limited sample size up here.
Excellent. Yeah, I think that's a great point in terms of stage of business. Well, great. Moving on to the next question we asked, and this is a really interesting one: in-person versus virtual connection. How important is physically meeting the founders in person before you make an investment? This has always been really important for Revel. Of 40 businesses that we're invested in, maybe 10% of companies we have not met. We've done deals, with only meeting virtually. So it was always something that we thought was incredibly important. But it's been really interesting. In April, almost all investors were saying, it's 50% were saying it's somewhat important, 50% were saying it's important, but nobody was saying, it's a must do. And I suspect that that's probably shifted. But does anybody, have any thoughts or comments in terms of, deals that you've done recently where you haven't met the founder? How does everybody feel about this, especially as we're kind of in a new normal and a new world?
Yeah, I mean, I agree with you, Chris. Like, previously, it's very important for me to meet the founder before I invest. However, it is a new normal. And I think Zoom, if the data is there, then to Randall's point, I think you can still make an investment from a virtual connection. Much harder for the new entrepreneur that has yet to go to market. I still think it is difficult.
It's a challenge for us, I'll say. Our business model traditionally has been to play the role typically of the local or regional financial lead investor on a first institutional round. So whether you call it seed or A round or pre-A, seed 2, doesn't matter. We'll write a check usually from 1 to 5 million, and then somebody else will help bring in for another 1 to 5 million. And so it's a $2 to $10 million round. And these are typically in the Northwest, these are typically first-time venture-backed founders. So there's many fewer serial venture-backed entrepreneurs up here than, say, the Valley. And I know that we're all non-Valley, so we can all kind of dunk on the Valley. But the idea is up here, it's first-time venture-backed founders. So when you're leading that first institutional round, you generally need to syndicate, and you're needing to do a lot more sort of coaching and kind of molding together of a deal. There's fewer prepackaged, ready-made, obviously going to get funded deals with great data and great, term sheets are due on Tuesday, let's get them in, guys, and we'll pick one. That dynamic is much less prevalent historically up here. And there traditionally is a lot more of kind of working through getting to know founding teams, sometimes even kind of helping to build founding teams and coach them well in advance. So it's going to be a challenge. It's going to be a real challenge for us. And so I'm personally very curious about things like what Tatcha is doing with respect to ways to make connections among folks and try to foster the sort of closer working relationships pre-investment that can lead to those levels of trust and understanding. We have a portfolio company called, we have a couple of portfolio companies on this theme, but one called Imperative that is based on within a company, matching up folks for peer-to-peer video mediated coaching and mentoring, so that you can kind of, maybe you can't hire a CEO coach or a VP level executive coach for everyone in your company, but you can offer that sort of connection to somebody who's not you're sitting in the cubicle next to you or never was sitting in the cubicle next to you. But I think virtual ways of fostering these working relationships and building those trust connections is going to be very important in a world where you can't do it as easily face-to-face or for the coffee meetings and all this other stuff that's kind of the traditional part of our business.
Yeah, 100%. Yeah, of the 5 deals that Revel's done this year, we have just done 2 deals, one in a company called Blackheart and one in a company called Native Voice. And both of those CEOs, we haven't met. So it was virtual, but you do 4 or 5 different video Zooms with the entrepreneurs. We kind of felt good about that and have proceeded. So if Revel is a data point, we're certainly moving forward with the new normal. But I think I'm preaching to the choir that 80% of an investment, as far as I'm concerned, is the entrepreneur. Is the ability, does this person have the ability to execute? So, with that, it's been critically important to spend time, break bread with the entrepreneur physically, but even I've let go, and we've moved forward to do deals virtually. So, all right, let's move on to the next slide. I see a lot of questions coming in around sectors. What are the hot sectors? What aren't? Et cetera. So we'll get to that in one sec. One more slide before we get to that. How much more difficult do you believe fundraising will be for your portfolio companies in the coming year? And investors at the beginning of April, almost all investors believe their portfolios are going to have more difficulty, with 45% saying it's going to be slightly more difficult and 50% saying it's going to be much more difficult. For the group, anybody who wants to jump in, how do you feel now, sitting in July, 3 months into C19? How do you feel about fundraising for your startups, and how are you advising your portfolio companies here? I can certainly jump in with some of my thoughts here. I think it's been echoed by some, by the panelists so far. The cream kind of rises to the top. So if you have the kick-ass metrics, you're not gonna, if you're growing 200% year over year, looking to do an A round, you've got your ARR up at 1.5, 2 million. You've built your core team. You're in a hot sector. You're going to be able to raise capital, and you probably won't have a huge hit to your valuation. So it's really very company specific as opposed to across the board, because there's a huge overhang of capital out there in terms of venture funds that have raised a lot of money and they need to deploy it. So they're looking for good business opportunities with differentiated tech, teams that are executing. So that would, be some of my feedback on this point. So with that, let's jump to the next slide on kind of the impacted sectors that we've seen. There have been a lot of questions around this. Jeff Fox is asking, are certain business deals being abandoned, either existing investments or new? The reason being the industry sector is going to suffer for the foreseeable future, for example, travel related, and the opposite are certain industries more attractive: online retail, predictive analytics, online education. these were the survey results of up and down sectors. So I'd open it up. Thomas, you know, from your end, what are you seeing as the attractive sectors? You know, and also, given that, you know, there was an interesting question that somebody submitted last night saying, you know, given that how strong the public tech markets are right now during this pandemic, how has this impacted your own venture tech investments? How well are they doing? So curious, Thomas, if you've got some thoughts around sectors and performance within those sectors.
Sure. Well, right now, everything what has written telemedicine on top of it is funded within minutes. We found a really interesting company, but we could not even submit a term sheet before it was funded. And so we see it across the board. So this area is right now in the focus of every VC, and they're hunting down the startups. So if you're having a startup in this area, so raise capital now. Now is the time. On the other side, sectors for sure, like travel, or if you want to build a new aircraft, this will be pretty hard to fund in the moment. Yeah, so everything in this category is hotel, travel, entertainment. So I would be very, very careful as a VC to invest, but also if you're a funder, so make sure that you have enough cash reserves. So we have a couple of travel companies in our portfolio, and we advise them, okay, keep your cash together. Yeah, so you're now in for the long run. So we hope there will be a vaccine in the next 24 months or earlier, but so this is a time you should have cash in the bank, and if not, so scale down your operations and make sure you survive this. On top of that, there's like my favorite sector right now, esports. Yeah, so I was a strong believer in this sector 10 years ago. I was 5 years ago, and especially now, this is the next big thing. I think, first of all, the younger generation loves it. Yeah, it will replace baseball, soccer, and football, which I think is not a bad thing, but anyhow. But so I like esports. I'm pro, and so with all these kids sitting at home playing computer, this will be professionalized in no time. So if you find there interesting and sexy investment ideas, take a look. I think this is a sector which will boom rapidly in the future. On top of that, so I think you need to think now about the new normal, and the question will be, will it change back? So I think it's not even a bad thing, so that your kids don't need to go to school. You don't need to drive them anymore there. Yeah, you can homeschool them. You put them in front of an iPad, and so better buy some earplugs with noise canceling. That's probably what you will get used to. So education, that would be a big field I would look into. There will be new ways of conferencing. Yeah, so I don't believe Zoom will take it all. There will be the new wave of new apps, yeah, so which will give us a better communication, maybe even giving us a virtual way to meet people again. Yeah, so I'm a strong believer in meeting people and feeling the sympathy and the relationship, and have a drink in the bar and a good glass of wine and maybe a nice dinner. And so yes, of course I miss it, and maybe there's another way of meeting in a new hologram virtual reality where we have partly this experience. So check out the sectors. So I would bet on those.
That's great. How about Kim and Randall? What are your thoughts in terms of sectors that you think are very well positioned, or that interest you? We have a question that just came in. What are you seeing in terms of functional areas for e-commerce in the tech stack outside of, say, Shopify? As a more specific question, if anybody's got a POV on areas of e-commerce, but just in general, Kim or Randall, love your thoughts.
Well, on the e-commerce one, I'd like to thank my partner who clearly logged in and gave a softball. But we've got a portfolio company called Sound Commerce, that is engaged on exactly this problem, which is to say that in the world of e-commerce, the new breed of direct-to-consumer companies, they all have gone out and kind of picked the best of breed in many different functional areas, and the ability to stitch that together in a meaningful way, to make the systems talk to each other, to have one view, one pane of glass, so that your folks who are customer facing can actually know between the shipping and the purchase and the discounts and the total customer lifetime value of a given customer and how they should interact with them. There's no way to do that today until Sound Commerce kind of knits this all together. So we see, as has happened in many, many sectors over and over, the complexity of a rush to go build a bunch of functional kind of silos ends up creating opportunity to create an overarching view and an overarching integration and an orchestration over those silos. So that's what we see with a company called Sound Commerce in our portfolio. But more broadly, I think the future of work thing, super interesting. Another portfolio company that we invested in last year, I looked at originally with a slightly different lens. So obviously it wasn't a COVID lens at the time, but I think of social media as over the last 5 to 10 years in particular, has sown a great amount of distraction, discord, and division in our lives. So you've got the Facebook algorithm is promoting the most divisive and the most outrageous thing, and it's the crazy uncle tweeting the conspiracy theories, and it's the activists over here tweeting. And so it tends to split us, and it tends to divide us and distract us. But it doesn't need to. That's a choice, and that's based upon the attention economy and the ad-fueled model. We have an investment we made last year we're very proud of in British Columbia called Thought Exchange. And they tend to be used when an organization or a group wants to hold communications and conversations at scale. And the way it's architected, the way that it flows, tends to create consensus and collaboration and agreement among the people who are having the conversation. So it's a choice, right? You can build your communication channels and methods so that only the loudest voice and the most divisive voice is valued, or you can build the methods that tend to create more agreement and consensus and collaboration. And so I have a great hope that people, especially now that so much of our conversations in work and in many other areas in public life and politics will have to be mediated by technology, at least in this medium term of COVID land. It's going to go through technology. And is it going to go through the most divisive, distracting, and sort of polarizing technology? Or are the media that we can use that will tend to create consensus and tend to create agreement, and tend to allow us to form some kind of positive, beneficial collective action where everyone feels heard and everybody can agree? And good God, if we can't even get everybody to agree to wear a mask when they're riding the bus, who knows as a society if we're going to survive. So I'm bullish on the need for this. It's a trick of finding business cases where the venture model can be applied to that. But that's something I see in the future of work. I call it the future of collaboration more broadly.
100%. 100%. Kim, I know you're an angel investor. You've been, focused on a business doing vitamins, brain enhancing performance, better productivity. How have you found e-commerce, B2C? What's that been like in the wake of C19, and what are your thoughts there?
Yeah, I think when you look at the opportunities, without a doubt, there's a lot within contactless commerce, within telemedicine, I have 4 children. So what is the future of work and school? That to me, every day, I think, what am I going to do? So there's a lot of opportunities that the current environment are creating. And I think it's about how do we use technology in order to streamline those opportunities. And yes, to your point, I'd love some of the D2C and some of the new opportunities to create new products and the vertical integration of that. So just capitalizing on that.
Yeah. And we've got a couple of questions. Brett Harnett is asking, any change in interest in the ballooning aging senior market? And John Bassar is asking, what are the panelists' sentiments on the cannabis industry right now? Anybody care to weigh in on the senior market and on cannabis?
I could weigh in on the cannabis because I have two investments, one on from a technology perspective and just one from a product perspective. But I just think regulation is hard from cannabis right now. I think that's really it's like a pausing point. It's like and you see that in the market as well. So I think there's a lot of, especially in the US, I think there's a lot of opportunity, but I also think just based on regulation and COVID and the current crisis, that's been pushed back. So I think I'm actually bullish on that, but I don't think that right now, I think it's just much harder.
Got it. All right, good. So let's move on to kind of a part two here, talking about some advice, some practical advice for early stage CEOs. There've been a lot of questions around a variety of things. One is advice for managing my business, and the other is advice for fundraising. So I guess, Thomas, let me start with you. Kind of given the background that we've just discussed in venture funding in the landscape right now, what kind of attributes do businesses have to have right now to get funded?
I would say right now is a time for me that the business needs to have a product or a service which is a must-have, not a nice-to-have. In the past, there have been a lot of companies funded which have nice-to-have businesses. So when you have, I don't know, 100 million in your budget and you don't know where to put it, where this business is, which we're profiting from it right now. So everybody is probably a little bit more cautious. Yeah. So thinking about like, okay, so how is my budget next year? So will I need to do some more savings? That means all businesses which have a must-have service or product, they will profit from it. So they will be safe. They will have long-term agreements and they don't need to worry so much. So I think that's probably one of the things I ask myself before I do any new investments right now. Yeah. So is it a must-have? And then, so obviously the regular criteria. Yeah. Founder, team, you know it. Yeah.
A couple of questions just came in. One being Tom Jennings asking, what are your thoughts on the opportunities and threats in digital advertising? So Thomas or Kim, I know, given Amobi, you guys are both pros in the digital advertising and MarTech space. Thomas, you're talking about, must have really center of the plate offerings within that specific sector. What are the last frontiers in terms of the digital ad sector, if any? What would you guys have to say about that, to Tom's question?
Kim, you want to go first?
I'm going to hold my digital advertising comments.
And I can jump in too.
Okay. Well, somebody needs to go first.
All right. I mean, I would say, Tom, in terms of opportunities and threats in digital advertising, certainly the threats are, and this comes up every time Rebel looks at an ad tech deal, is we talk about the walled gardens. We talk about Facebook, Google. Thomas or I will always say when Joe's excited about an ad tech deal, we'll say, oh, well, what's to stop Facebook or Google from totally destroying this, gobbling up and offering this service for free. So that is definitely, and Joe's response is always, they have bigger fish to fry. Trust me, they're not looking at this little dinky sector, which to Thomas's point, if you're looking at ad tech, you need to be a very center of the plate business solution. But I would say the opportunities in digital advertising are probably around, data, very specific data moats, where you're leveraging data, you're bringing in data, and creating very interesting data sets that can be featured. I suspect Thomas may disagree with me on that, but those are some of my thoughts there. We also have a question.
With you, Chris. I agree. There's great opportunities in identity, in data analytics. I think I'm a big believer in connected TV. So there are opportunities within the advertising sector. I mean, we've all spent the last 20 years doing that. And I think there are, but also to the point of just what is the need and is it going to, you know, the giants are there and just being aware of that, right?
For sure, 100%. You know, Randall, we have a question coming in from Tristan Anzalag asking, do you think COVID-19 will impact the cryptocurrency markets? Do you have any thoughts, or, you know, anybody jump in on crypto? I know Bitcoin's been pretty much, you know, floating around 9,000 pretty much throughout this whole crisis. But what are people's thoughts on crypto markets in general?
I'm the wrong guy to ask. I've seen, I think, 4 deals that are crypto deals that I think have a business underlying them that is separate from a, you know, speculative scheme, and that's of hundreds. So there are, but certainly there are good cryptocurrency ideas and good cryptocurrency businesses out there. I just don't know that this COVID affects them differently than it affects any other type of startup that's not, you know, directly in sort of like one of the affected verticals like travel, food and bev, this kind of thing.
Yeah.
I agree. All my crypto investments are underwater. So ask me when the Bitcoin hit 20,000 again, and then I change my opinion. Until then, don't send me any business plans about crypto, please.
Okay. Well, there you have it. So, you
Buy
know,
gold.
You know, in terms of, there've been a couple of questions around, you know, what's the balance? What's the right balance? And Randall, maybe this is a better question for you around what's the balance between growth and profitability for early stage companies as they're kind of, you know, and the trade-offs between bootstrapping versus raising an A round with venture funds during this time. What are people's thoughts? I mean, have the metrics around, you know, just elevated to such an extent for, you know, for raising seed rounds or A rounds? Let's focus on seed. Sorry, I'm a little all over the place. There've been a lot of questions coming in from people starting businesses, seed centric. Should they be bootstrapping? Should they be trying to get, you know, some foundational capital underneath them? You know, what's some guidance for people that are just setting out? Kim, I know you focus a lot at the very, very early stage. What's some advice for really early stage entrepreneurs that are starting about, you know, thinking about getting their businesses going?
Yeah, I mean, I personally think so. I've bootstrapped and I've raised, and in the current environment, if you're able to bootstrap, that's great because it's going to be harder to raise without the track record. I mean, I just think it is. And it also, I mean, obviously there's cash is king though. So if you do have the metrics and the data to support a raise, then I would 100%, I would raise, because there is the growth that it can supercharge your growth and it's got such great benefits. But the reality is it will be harder right now. So I would go in thinking you may not be able to close the round or you may not be able to raise, and making sure your economics of your business model and your costs are in line with that, right? Like, I think it's really important. Everything's going to take twice as long and cost twice as much as you think it is. And it's like, especially in these times, being really cash conscious, right?
100%. I think that's great advice. Randall, do you have anything?
Yeah, I mean, all I have is a hammer, so everything's got to look like a nail to me, right? But in B2B land, it's absolutely never been cheaper to go test out something and see if it works. And in fact, this has kind of now become this conventional wisdom of, you know, fake it till you make it, and agile and lean, and you know, product market fit, and doing all this stuff, pivoting. I mean, look, that's been conventional wisdom now for going on 10 years, and it's only gotten sort of cheaper and more accessible to build these things and test them out in many ways. And I'd say there's been a rise, and this is a little bit contrary to interest, right? There's been a rise in alternatives to VC funding. So we funded a company about 10 years ago called Lighter Capital that was originally just a sort of niche player for certain kinds of SaaS businesses and subscription companies that were sort of just emerging as the standard then. And now they're thriving. They've deployed over 200 million in capital in these loans of typically 200,000 to $1 million to businesses that don't want to or can't, but largely are just choosing not to try to pursue a traditional equity raise. And it may be great to have a business that doubles instead of triples, and you own it all and you keep it, or maybe it grows 50%. But it's pretty awesome as a founder to be able to drop profits to the bottom line. And so I think that there's a lot of opportunity to do that. The flip side is that venture always has been and continues to be about pursuing an opportunity of a scale that really isn't achievable in other ways, and sort of taking it orders of magnitude and several orders of magnitude over the life of the investment and of the company. And if that's in the cards, and if that's where you want to go, then I think you try to get on the train, and you to use an old phrase from the last big bubble that popped, is the time to eat the hors d'oeuvres is when they're going around. And presently, there's still some hors d'oeuvres on the tray, despite the 90. I think you said 45% plus 52%. 97% of your respondents said that they thought that it was going to be slightly or significantly more difficult to raise. But right now, deals are still getting done. We had a valuations survey from public markets that we just looked at for SaaS companies, all-time high multiples, all-time high SaaS multiples. So in my world of B2B, largely SaaS, things are still getting funded. The gates are still open. It's not quite the free for all that it might have been, 12 months ago, but I'd say that it's very bimodal. If this is the world you want to be in, smaller growth, lower growth, I think Kim is quite right. It's attractive to do that. Bootstrapping is good, and you can retain all ownership. And there's more opportunity and resources for you there than ever before in terms of financing and whatnot. But if you were trying to really shoot the moon, there's really only one path, and you can still kind of that path is still open by and large, in my view, and in my sector and geography. That may change, though. I kind of think we have a Wile E. Coyote economy, okay? So we've run right off the damn cliff, and we just haven't noticed. And then at some point, there's going to be a reckoning, and that reckoning plays through financial markets. So when the stock market drops 20%, like it or not, the angels tighten their purses, and the VCs tighten their purses, and the LPs tighten their purses. And so it'll happen. It'll happen again. Yeah. And maybe we're overdue, or maybe I just don't understand how it all works.
Well, and Randall, I think that's a very good point. And what we've seen with public SaaS multiples are now on average at 18 times revenue, where a year ago the average was 10x. So that has had a trickle effect into hot deals that are center of the plate. To Thomas's point, these hot deals, especially in big, traditionally expensive markets like the Valley in San Francisco, deals are getting done at pretty good valuations, but for a very small subset of high performing companies. A lot of other companies are seeing this kind of 20% decline in valuations.
Yeah, it's bimodal. Or that may not be the right statistics word, okay? But like on this side, if you've got all the characteristics, the multiples have gone up. The deal that would have been a 6 to 8x is now an 8 to 10x in my private markets world, which is kind of unfathomable that in the middle of the GDP dropping.
Yeah, 100%.
Quarter over quarter.
Jake, maybe put up the SaaS napkin on the screen. There've been a lot of questions around specific metrics that VCs are looking for. And I love what is known as the SaaS napkin. Christoph Jantz over at Point 9 Capital updates this every year, and I just love it. I think it's really neat. In terms of on the left column, talking about what are some key metrics that VCs look at, and this is based on a survey of 65 different venture capital companies across the US, looking at ARR growth, valuation, round size, what are folks looking for in terms of the team, what are they looking for the product, sales, modes of differentiation. And then they're looking at the metrics for what are we looking for seed, for Series A stage companies and Series B stage companies. So I find, so for example, if you're an A round looking to raise an A, you should be doing about 1 to 1.5 million in annual recurring revenue. If you're at the seed stage, very early stage, well, you're probably going to be doing 0 to about, $200,000 a month, but you can really see the growth rate. Investors are looking for at least a 2x year over year annual growth rate in terms of your ARR. And then you can see where, these valuations are coming out at, and what the average round sizes are for a seed round versus an A round. A rounds have really gone up. The more venture capital that's been out in the market, the more the round sizes have gone up because investors have more money that they want to deploy. And then, what are people looking for in terms of a team? So for a lot of questions are coming in around seed stage. At the seed stage, outstanding team with strong product sense, strong domain expertise. They've got a real background in the space that they've invested. Any of the panelists have any thoughts or anything they want to add around any of this? It's all pretty self-explanatory.
That's a pretty good napkin.
I'll do a little cell phone here. Seattle, historically, our angel community and to a lesser extent, our recently emerged seed investing community has been kind of over-indexed on revenue. So looking at folks who have 200K in ARR, that seems kind of light as the top end of the seed range there. So because a lot of times I've seen angel rounds where they're hemming and hawing about, oh, I only got 500K in ARR. And I'm like, so for us, what we try to do at Voyager is we try to look at the revenue numbers and just treat them not as revenue. Yes, you happen to be able to spend it on other things, okay? But is it a signal of emerging product market fit? And so that depends on the deal size and all this other stuff. So I'd be much more interested in if you're selling the same kind of company, the same firmographic, the same title of a user or purchaser within that company, and they're using it for the same reason. They're buying it for the same reason, using it the same way. So those are much more important to me than if you have, quite a bit more revenue, but they're scattershot across the board. Other than that, I'd say that this looks pretty reasonable. It's probably I tune everything down by 15 to 20% in our off markets or kind of our lesser population markets in the Northwest. So Portland, Oregon, Vancouver, BC. This is pretty close for Seattle.
Yeah. No, that's I found that this has been a really good guide and more questions coming through on the seed stage. One thing I think is really important as you're putting your business together is really conveying to people like Kim, who are big angel investors at the early stage, the vision, and really, where are you, what's your beachhead? How are you going to approach this? But what's your big vision? And being able to kind of have that critical path. I remember meeting with Jeff Green at the trade desk back in 2008 or 2009, when he didn't have a business, he just had an investor deck, but I could see his vision and he laid it out. He had a laser focused critical path of what he was going to do. He had been in the market, he'd identified a problem, he had a clear visual and a roadmap on what the solution was, and he went off and did it. One of the few entrepreneurs I've seen execute a business without pivoting. I had 2 businesses, I pivoted them both. So I think that's important, is when you're meeting with angel investors or early stage seed investors, is really having a clarity of vision and letting the investor know that you really understand the space. You really understand the racetrack that you're building a car to go race around, would be my advice for some of those early stage founders there. So we've only got a couple of minutes left. Does anybody on the panel, Thomas, Randall, Kim, Tatya, have any kind of closing thoughts in terms of COVID-19, investment cadence, advice for entrepreneurs, anything they want to throw out there?
I mean, my advice is just don't give up, because it's a hard market. Like, we know that, but there's been hard markets before. And if you have a great idea, it's like, how are you going to make it happen? How are you going to execute it? And if you can't raise money now, like to Randall's point, there's opportunities to still build out the prototype, build out the market demand, build out, it's never been cheaper to be able to start something and test it. So, I am a huge believer in the entrepreneur, and I do think right now is an interesting time, but in 10 years, we will look back and great companies will have been built.
100%.
I 100% agree with Kim. I would say struggle is where greatness comes from. And through challenging times right now, so this is a time when great companies can be built. And also always keep in your mind, if you cannot raise capital, none of your competitors can. And this basically equals the odds. Yeah, so that means, so if you cannot tap into the big Silicon Valley pool and raise 30 or 50 million in the seed round, so you have no fair fighting chance. And I think the next couple of years, this is where great entrepreneurs can create global businesses. So go ahead and get started.
And I'd say, look, if you're in an execution mode where you've got a meaningful balance sheet and P&L and you're running it, make sure that you have a plan that gets you runway through the end of 2021 at the very least, and you have a way to survive into 2022 without needing to raise capital if you haven't done so, or raise it right now by hook or by crook. Get lines. If you need to get loans, get loans. If you need to raise equity, raise equity. It's still, the door is reasonably open, and it may not stay open. So that's the way we've been treating our portfolio, is trying to really make sure everyone's funded through at least the next 18 months. And on the other hand, if you're not yet sort of in business and really managing to cash that way because you don't have any cash yet and you're trying to figure stuff out, get customers to pay. No more freebies. Treat the customer paying you for your crappy prototype that barely works as a test of how much they want it, and it's market validation. Get them to pay. I was on the phone yesterday with two entrepreneurs who were trying to talk about how they wanted to lower barriers to adoption. No, put barriers up. If in this environment, if a B2B buyer spends money on your thing, on your new untested product, if in this environment they do, they really want it. So that this is kind of a golden opportunity to the signal to noise ratio can be really changed because budgets are being cut, things are really tight. So if they spend money, they want it. So make them spend the money. That's my biggest advice to the pre-product market fit, pre-revenue folks. So.
Well, fantastic. Well, thank you, wonderful panelists, for your time. Tatya, thank you to you and to the team at Upnotch. Really wonderful conversation. Thank you to everybody who attended. I think we peaked out around 115 participants, so that's terrific. I hope we were able to address a lot of your questions about the industry and advice around fundraising, and we're able to provide value and give you a good return on your time spent with us today. So with that, thank you everybody, and stay safe. Wear your masks. Thanks.